In this video, I discuss why the crypto markets have been crashing. It has been a heavy crash on Monday morning. In this video, I'll go through all the things that have been taking place and are important to know behind this crash, whether it's going to continue or not. At the end of this video, I'll explain my personal game plan, going through all these things and my expectations for the coming months. The markets have been crashing substantially, but before we continue with that, I would like to have a small note on my personal stuff, which is I've seen some comments questioning my eyes or my skin, etc, etc. I'm not tired, I'm feeling quite okay, but I've quit having some medication for my health, which technically says or gives me a response through my skin and therefore also through my eyes, which is going to take a few weeks or a few months, I simply don't know. But that's why you see me struggling with my skin or with my eyes. That's just a response. I doubted whether I wanted to continue, but I would like to continue because I like what I'm doing, which is why I wanted to be open and transparent to you guys that if you see me like this, I'm okay. I'm just recovering from medication. Now, going back to the markets, there are multiple reasons for the actual correction, which I think you can categorize in 4 different reasons. And then the question becomes, does it have an impact on the market or doesn't it? Which is the first one is the global unrest that we have. And I would like to specify the Middle East or Israel, which is taking a bigger toll at this point. We also have Venezuela. We also have some other countries. There's a lot of things happening at this point because the gap between rich and poor is increasing substantially. Now, the Middle East is accelerating extensively, and that is definitely true. The second reason is that we're getting the UK being completely hammered at this point, as there are so many riots taking place, which we'll discuss in a little bit. The third reason is the fact that we've had a very bad economic data on Friday. If you put everything into perspective, it's not as bad as you think it is, but it was quite bad due to the expectations being completely off. Now, reason 4 is Japan crashing on Monday morning, as the Nikkei index has seen the worst day since 1987, since Black Monday, which was causing the yen to go up, but has also have an impact on the market. So now if you have these 4 reasons, then I think that the global unrest is not impacting the markets. As a matter of fact, wars usually have a positive impact. The UK is technically relatively small for the global markets to have an impact, but I think in the UK itself it does have an impact. The economic data of Friday was being disastrous, and that had a huge impact as it triggered the 4th reason to actually accelerate. So I think that due to 4 triggers, and that's what caused this massive crash. And then the question is this crash the start of a bear market and the crisis, which I've been saying for a few years? Or is this just a bump on the ride, and is this a buy the dip expectation for the markets and especially for crypto? But let's go through the 4 reasons before I'm going to hand off this towards my strategy. The 4 reasons, the first one was the global tension that has been happening. Of course, we know that there is a war in Gaza, in Israel, taking place between Palestine and Israel. Well, you can say it's not really Israel or Palestine anymore, as there are a lot of parties involved. But last week's the leader of Hamas was killed in Tehran in Iran, which triggered a bigger impact on the markets as Iran needs to respond. There will be likely a retaliation taking place, but I think the overall question is, are we already into World War III, or are we going to be waiting until another acceleration is going to take place? At this point, it's still relatively calm. At least the news providers are not bringing a lot of news towards Europe, so it's hard for me to decide. But this particular reason is not impacting the markets as much as we think it should. I think the real reason is one of the other ones that I've been saying. Now, The second one is the UK getting hammered, and the UK is having a significant impact due to the stabbing in Southport, which was due to an immigrant that have been taking a 17-year-old immigrant taking 3 kids their lives. However, that was false, or suspectedly false, but that triggered a lot of riots to be taking place, including hooligans from football clubs taking in. And it's just showing how bad the society is going to be, or is at this point, and how fragile the world is at this point, where there's no respect for any other anymore. But I will be discussing that in a different video. This reason is also not impacting the markets as much. Now, the actual reasons are the fact that the economic data on Friday was disastrous. So we had unemployment rate that came in at 4.3%, while 4.1% was expected. But also the amount of ADP jobs creation was way worse than expected. So automatically there was a reaction expecting that there is going to be a recession. Especially this data was not expected after on Wednesday Powell has stated that the Fed was not going to do a rate cut and that the economy is doing great, and which is actually quite right at this point yet, because GDP advanced for Q2 came out as very positive in the sense that there was a 2.8% growth on the GDP. So the economy is doing great, but the labor markets are already slowing down, which has caused the yields and the interest rates to fall off a cliff. The yields have been falling by more than 1% in a month's time. So where we have been seeing 5%, it dropped to 3.8% and even worse. And these big shock impacts are disastrous for the markets. If you recall correctly, we had a 0% interest rate on treasury bonds for a long time. But then it started to go up very fast, and then Silicon Valley Bank, Signature Bank, and a lot of other banks that were using these treasury bonds at these lower rates got hammered because the intrinsic value of these bonds were going to zero. So that had an impact, and this is the other way around, because the fact that the rates were going to go down caused Japan to crash, and that is due to the yen carry trade, which is the yen started to rally up after the fact that there was a big announcement from the Bank of Japan. But the yen started to go up, and as a response, we saw the Nikkei index starting to fall off a cliff. It has seen the worst day since Black Monday in 1987. It dropped by 12.5%. Now the question is, what is the actual yen carry trade? The interest rate in Japan has been staying at 0% for a long time. So what could you do? You could borrow the Japanese yen, and you could use that money to invest into treasury bonds in the US and get 5% return, give and take. You could also invest it into crypto, stocks, real estate, whatever you want, because this is technically free money, which we've also been seeing in the US. And this is just the return that you can get out of it to pay back your debt. However, if the interest rates start to go up from 0 to 0.25%, that has an impact on the risk that you can take. So you need to rebalance that position. But just as we've seen that shock with Silicon Valley Bank and stuff, having this impact, it also changes the valuations between the two currencies. So that's why the Japanese yen started to run up, and this Forex run up, which can also be like 1% already, that Forex run up switches it even more, and that's when you can get the acceleration through which this big market crash happened, where few big parties got liquidated, or at least the markets are going back into equilibrium, where you overshoot to the downside and get back up to normal state after that. But it's just waking up the markets, through which the Bank of Japan, as I said, raised their interest rates for the first time since 2007, which is for the first time in 17 years. And now on the same day, it doesn't really show anything yet, but the US announced a treasury buyback program where they inject $30 billion into the economy to push the economy forward. So it's going to continue. The QE is going to continue. And as a response, I think stocks are going to have the final run. I think the Nikkei is going to have the final run. And I think crypto is going to go ballistic, as we have seen that there is interest into this asset and that crypto can quickly bounce back. This entire trade was a lot of macroeconomics, but given that Jump Trading, a crypto fund, was doing this with crypto, over the weekend Ethereum got crashed due to the sell-off coming from Jump Trading due to the impact on crypto. But as a whole, I think that is not going to continue. Now, the altcoins were suffering. ETH has seen a 40% correction in just a matter of weeks, and it has been dropping towards $2,100. ETH against Bitcoin made a new low, but it showed that during these periods of heavy correction, that is actually where you are likely going to find a bottom. That is, it's just capitulation is bottoming time. Optimism made a new low, but is already coming back strongly as it is up above $1.30 at this point, quickly rebounding from their lows. Now, additionally, what we've also been seeing yesterday is that due to the correction, you want to know whether the markets are staying resilient and whether DeFi works. Well, DeFi worked because Aave made more than 6 million during this day, but also ETH in general, due to the heavy attraction that we can see, became deflationary. So where Bitcoin had an increase of 0.8%, we've seen that ETH did have a decrease of 0.8% in terms of inflation. So it became deflationary, and then additionally the ETH inflow was positive by 8 million for ETH. So this reminds me a lot of the COVID-19 crash that we had. It's very similar, or in this case probably less heavy, but the same impact, where a lot of panic has been caused and the markets are quickly bouncing back up. It also reminds me, if you go back in charts, to Japan Black Monday, where we've seen that in 1987 we've had a massive correction on the markets for Japan, and after that the markets continued to go up for more than 2 years before landing into the biggest crisis ever. And that is where the US is going to go to. 2 more years and then the system cracks, which is 2 more years of party on crypto where you can make the money. So coming back to my personal strategy, I have not been able to buy in this actual dip because I'm already fully allocated. I said it already. But I've not been selling. And it's not about using your emotions to take decisions, but being rational. And if your thesis didn't change, then you should be sticking to it. It is about staying into the game. And I think that what happened in the macroeconomics strengthened my case of being in ETH, being in DeFi, being into the newer coins, because I think that the markets are going to bounce back very swiftly and are going to go ballistic in the coming few months, through which it reminds me of what we've seen at the end of 2020. I did the same and I lost around 60 to 70% of my portfolio, after which the big run took place. And I think in some way we're going to have the exact same, especially if QE starts and rate cuts start to happen and global unrest is going to increase. It's going to be driving more people towards crypto. So my advice would be stick in the game, hold your positions, make wise decisions of which ones you're holding, and you'll be fine. Thank you for watching to this additional update. I'll be back on Sunday. Ciao.